Welcome to TheoTrade. This is Don Kaufman. It's July 9th, 2016, doing our Theo video weekend update. Let's kick it off this weekend, giving you a quick update. I'm going to start with a 3-year daily. Now, remember, not a big technical analysis individual. I'm much more of the quantitative kind of category. One thing I do look at quite considerably is going to be relationships in the market. And what we're looking at here, again, to kind of kick this off, are just that, relationships. So we're going to look at the NASDAQ versus the spiders versus the Russell. And I've decided in this particular comparison to use the Qs, the spiders, and the IWM. IWM being, of course, the Russell ETF. Let's go ahead and label them, and we're just going to jump right into this. So leading the pack over the last 3 years, and again, I want to be very clear, this is a 3-year daily, leading the pack to the upside over the last 3 years. What do we have? We have the Qs. All right, right smack in the middle. You can see it actually color-coded right here. We are looking at the spiders, okay, and last, but definitely coming in least in terms of the major index products, we have the IWM. So why do I start with a 3-year daily and a comparison chart over here is to make a very simple point. During periods and bouts of volatility, and this isn't, something I've been discussing since years that I've been trading. We've been looking at this, but I've been discussing extensively here at TheoTrade over the last couple of months. If you're a little newer to these videos, though, stay tuned in. I'll explain it. During bouts of more extreme volatility, for example, you come back to, August of 2015, which is right here, okay? The index products have tendency to, instead of diverge, okay, they converge upon one another. So you can see right in this bout here, 2015, the products get, well, a lot closer, right? They converge upon one another. Once again, we hit a bout of volatility into January and February. What do the products do? They converge upon one another. And then again, during this last British exit over here, what do? All right, we see some pretty substantial volatility. Now, this doesn't look like much on a 3-year, but one thing that I've been playing around with this a little bit and not reading too deeply into it. Again, during periods of volatility. Now, volatility is usually associated with these just wild down moves, but that's not necessarily, okay, the marketplace that we live in today. And I'm actually going to show this in a moment by looking at implied volatility, which is an options volatility, and the implied volatility is looking out in the future. Okay, the implied volatility is incredibly and inherently low right now. The volatility has dropped out significantly, even during the British exit, which is this little blip on the radar screen right here. That little blip on the radar screen, that's the British exit, right? Even then, the volatility, the VIX itself, didn't get that high. So again, we're going to make some arguments here that I've actually been looking extensively at historical volatility, which is the annualized standard deviation of the past stock price movement. Nevertheless, okay, in more turbulent markets, what we often see again is convergence. Okay, and when we see this convergence, and that is all 3 of these products converging once again upon one another, and when we see that convergence, that is often the telltale sign of volatility again being imminent. Most often, again, volatility is associated with wild down moves, but it doesn't mean that volatility can't be associated with wild up moves like we have seen the last 2 trading weeks. Nevertheless, you'll find this interesting, possibly a little bit entertaining. Take it from a 3-year daily, take it down to a 3-month. What do you see? You're like, what? I don't really get it. All right? On a 3-month comparison, just to show you that the convergence is underway, the leading product in terms of the up move happens to be IWM. Middle product is Spider, and the laggard is the Qs. What am I getting at? It's the exact opposite. Just to prove the point that we're in a much more extreme volatility. And this is only over the last 3 months, that the products themselves, okay, that have been diverging now, this is diverging for years. they're coming together. And they're actually doing it, all right, in the very short duration here. They're coming together where you're seeing the Russell start to outperform both the spiders and the NASDAQ. The NASDAQ actually is the worst performer in the bunch. And this sets up, okay, for a much longer duration trade. You can't always think of like, well, what are we doing this week? What are we doing next week? Much longer duration trade. You could seriously consider being short the NASDAQ, long the Russell. Again, I put everything into context of some trade idea, okay? But if you're not into the trade idea, that's a little bit of pairs trading, right? That's getting out there for some people. That's fine. But you got to open up your mind to more than, I think we're going up or I think we're going down. Because right now, okay, I think everybody have to agree, it's kind of hard to discern what we're going to do on a day-to-day basis, especially, okay, when we just get out of a day where the S&Ps rally 30 points. For what reason? It was a great jobs number. Wait, wasn't good news supposed to be bad for the market? Because if it's good news, they're going to, what? They're going to raise interest rates, and that's going to be bad for the market. But good news is good news, bad news is good news, all news is good news with Gary Gnews. Apparently, that's the case in this. So, with that, again, recognize there is still this convergence going on, that we're still in an extreme volatility. Now, to kind of further this, I'm going to go over here and I'm going to go into the spiders. Okay, so we're going to go into the spiders, and once again, I'm going to pull up a 3-year daily, okay, on the spiders, and I want to throw a study on here. And again, I'm not much of a market technician, but why we're looking at charts? Because there's an interesting one, and I think you really need to see the warning in here. We're going to go over to what's called historical volatility. Now, I've been doing this a lot lately, and we don't need no stinking volume, so let's go get rid of volume. So go in here, go over to equity, show volume subgraph, get rid of that, hit apply, hit OK. It's a party now. What I want you to see, historical volatility, again, just to give you the definition, it's the annualized standard deviation of the past stock price movement. What does it mean? Absolutely nothing. No, it means how much is the S&P really moving? And the answer is, if you look over 3 years, there's only a few times in the last 3 years that the index product itself has been rocking like it is right now. Why am I even mentioning this? So again, you can be a stock trader, you can be an options trader, you can be a futures trader. If you don't know this, okay, you're going to be blind to your risk. See, I'm an options geek. But it doesn't always mean that I just look at options data. One thing that really stands out to me, what we're looking at right now, and again, I've been harping on this as well recently, what we're looking at right now is the historical volatility is saying it's got about 20% movement in it. So volatility is always quoted in percentage terms. And again, this is historic volatility, yada, yada, yada. But then there's what they call implied vol, okay? Implied vol. The implied vol, well, you can relate that to the VIX. So, relate it to the VIX. Why should I relate it to the VIX? Because the VIX is the S&P 500 Volatility Index. Where's the VIX? 13. So, what does that really mean? If you go to the spiders, okay, and you just look at an options chain, and you go, well, about 30 days out, you're going to see, look how low the vols are, 12, 13, 14. So, what it's telling you is that option pricing, okay, is low relative to the actual movement. This does not happen very often. You know, it's not often either I talk about historical versus implied volatility. So again, I'm going to make this abundantly clear what this amounts to in the short duration. Actual movement of the market, okay, is higher than what implied volatility is pricing. What does that mean? Well, to me, I'll tell you what it means. It means the markets, okay, over the years have accumulated tons and tons of option premium sellers. If you're listening to this right now, you've probably sold some options premium, right? You sold a credit spread. Okay, I did a bull put spread. That's a credit spread. You know, I sold a bear call spread. Well, that's a call spread. You sold it. Lots of people are out there selling crap. Okay, I do it too. Right now, I'm not going to do it, especially in the index products. Now, I started cruising around looking at the equity products as well. So I thought to myself, well, let me look at Google. Is this going to be true in Google over here? I mean, Google's got earnings coming up, okay? But even if you look at the actual movement in Google, it's like 22%. You look at the implied volatility inside of Google. All right, it's 30% out here, but that's good at earnings. But again, the implied volatility is inherently incredibly low in Google. So this is actually resonating through the entire marketplace. What am I telling you? In the short term, you really want to consider using in-out spreads. What's an in-out spread? It's going to negate the volatility risk. When an in-out spread ultimately does, whether you're bullish or bearish, okay, it is often a directionally biased trade. That's okay. Directional bias is A-okay by me, but it's going out there and buying one option and selling another option against it. Okay, and it's a slightly in-the-money option. We're buying a slightly out-of-the-money option. We're selling, and we're doing that, okay, for a number of reasons. But one of the primary reasons in here is, okay, quite frankly, it just ain't worth selling the premium right now. I mean, I'm in the spiders, and I'm 20 days out, and these 215s, I mean, the 215 calls, these little monkeys, okay, are what? Not even $3 out of the money. They're trading for like 88 cents. Forget it. It's 12 volatility. Okay, and again, it's not often I tell you, I'm probably not going to be selling a whole lot of premium. And then I look way out in time, and way out in time, there's even a 16 vol. That's 104 days out. I know there's a lot of skew in the marketplace. Nevertheless, it doesn't exactly make me want to even sell an iron condor further out in time. And I'll tell you why. Because they're pricing in, all right, in the spiders. Or if you're more comfortable with, let's go to the granddaddy of all the products in the world, the SPX. Ladies and gentlemen, let's go to the SPX. You go to the SPX and you're like 80 some days out. I'm just using it for an example. It's giving you a 16 vol. Okay? 80 days from now, you're giving me a 16 vol and $132 expected move. Now, again, markets are sharp, but I don't like this low implied volatility. And I'm sorry, I don't care if the market is going to tag its all-time high. And let me be, again, relatively clear about this. We're only 4 or 5 points off the all-time high of the marketplace. And because the market's at the all-time high, the volatility is incredibly low. But if you look at the headwinds, like 83 days out, what's going to happen between now and 83 days from now? I don't know. The world comes to an end. China comes to an end. All right? Something ultimately happens. I'm not a seller of a premium. I'm not going to be a seller of premium with 83 days remaining with $132 expected move in the SPX. It just looks like too much risk at this point in time. One of the other things I did is, I started scanning for stuff. Again, earnings are coming up. So I'm going to continue to look for trade opportunities. And opportunities, okay, are everywhere right now. However, primary strategy, I'm going to be using these in-out spreads. I'm going to be on the buy side of options. Crazy as it sounds, for those of you that know what that means, I'm going to be long gamma. Long gamma. That Don does not do that very often. I actually want to be long gamma, long volatility right now. And that means, hey, out in the future here, I see, okay, volatility risks being relatively high. The market isn't pricing it that way. Now, that's my take, okay? Volatility is an opinion on direction, just like direction of the market. You could be bullish or bearish in markets. Right now, I'm bullish on volatility. Thanks, everybody, for joining me here at TheoTrade. Be back on throughout the course of this week in the TheoTrade chat room. Have a great weekend, everybody. Bye-bye.